We're looking at a high conviction investment analysis titled D-Wave QBTS Flash Sale, $ why smart money is buying this drop.
Yeah, I read this. It's got a really clear, high-energy contrarian thesis. It's effective.
It is.
But, to get this to that top-tier level, the kind of analysis that really moves serious capital, we need to focus on maximizing its persuasive power and its analytical rigor.
Okay, so let's jump right in. The first thing that really stands out is the language. Phrases like flash sale and calling the dip a shakeout.
It definitely grabs your attention.
It does, which is the point.
And that conviction is a strength. But, and this is the first main point, the material is highly aggressive, almost promotional language. I'm talking about flash sale or the load the boat zone. It risks undermining the credibility that, a more institutional reader is looking for.
Okay, I see that. But then, isn't there a risk you lose that energy, that punchiness that makes it stand out if you tone it down too much?
That's the balance, right? I mean, the weakness here is that relying on phrases like, they want your shares cheap, it frames the whole thing as more of a psychological battle.
Right, like market commentary instead of deep analysis.
Exactly. Sophisticated readers, they're looking for objective, data-driven reasons why an asset is mispriced, not, psychological warfare framing.
So the goal isn't to kill the conviction. It's to anchor the urgency in something more tangible, in metrics.
Precisely. The suggestion is to recalibrate the language. Let the actual data create the urgency. I mean, you have a 40% discount from the high. You've got a $39.89 average price target. That's exciting on its own.
So how would you apply that, say, to the title or the main thesis heading?
Well, for a concrete example, instead of leading with the flash sale thesis, maybe reframe that section as the valuation dislocation.
Ah, okay.
That's a term that immediately elevates it. Dislocation is the language of institutional investing. It implies a temporary mispricing.
I like that.
And then, when the report says the fundamentals haven't changed, expand on that. Don't just say it. Connect D-Wave's specific annealing tech to the computing bottlenecks we all know are coming in 2025-2026.
So you ground the thesis in a future high-level technological need.
Yes, that's what validates the long-term opportunity, not just the dip.
That makes a lot of sense, grounding it in that fundamental necessity. Okay, moving on. The report makes a strong case for institutional interest. It cites the strong buy consensus. But the whole title is Why Smart Money is Buying This Drop. That's a huge claim to hang everything on.
It is the central claim. And if you're going to make it, the evidence has to be ironclad. So while the fundamental case for D-Wave is laid out, the report needs stronger, more specific evidence to fully substantiate that core assertion.
And as I remember, the main piece of evidence cited was that small after-hours bounce, that tiny move up of what, less than 1%?
And there's the weakness. Describing a minor after-hours bounce is, well, it's just not enough.
It's pretty thin.
It's a single data point. It's an interpretation, not really verifiable proof that weak hands are out. It's not enough to support that strong narrative.
So what's the move then? How does an analyst find that proof? Without access to proprietary flow data, where do they look?
You have to introduce a secondary layer, something objective. The suggestion is to strengthen that link between the dip and the smart money by showing the mechanics of accumulation, not just the price result.
The mechanics. Okay, so you're talking about things like volume profiles?
Exactly. You give the reader something they can measure. For example, the report should dig into the volume during that consolidation period, from 12 p.m. to 4 p.m.
Okay.
Was that volume concentrated in large block trades? Say, orders over 10,000 shares. Did the average trade size jump dramatically compared to the small, panicky orders from the morning?
Ah, I see. Because a concentration of large block trades during a price drop is a much, much stronger signal.
It's a classic sign of absorption. It's what institutional accumulation actually looks like.
That's a far better indicator than a tiny after-hours bump.
It's empirical depth. It moves the argument from just an interpretation to actual evidence. And that's what a claim this big really needs.
That's a really valuable insight. Okay, for the last point, let's talk about structure. And specifically how actionable the report is. I noticed something a little disjointed. The critical support level's around $27. That's defined as the line in the sand. But the stop loss, the risk warning for a close below $26, that's in a totally separate section later on.
Yeah, I noticed that too. And in a high-conviction analysis like this, that separation can be a problem. The placement of that risk warning, the invalidation point, it should be structurally integrated directly into the technical breakdown.
Why is that so critical, though? I mean, the information is still in the report, right? It's just a paragraph or two later.
The weakness is the cognitive load it creates. When you're making fast decisions, you shouldn't have to cross-reference two different sections to understand your immediate capital risk.
Right.
It reduces the flow. It increases the cognitive friction at the exact moment someone is trying to make a decision.
So you're forced to pause and do the math yourself instead of seeing the full risk-reward picture laid out in one go.
Precisely. So the suggestion is really simple. Consolidate it. Put the support level, the line in the sand, and the invalidation criteria all together in one unified risk matrix, right there in the technical section.
One single point of reference.
Yes, it makes the whole thing instantly actionable and incredibly transparent about the risk.
So what would that sound like? Can you give a concrete example of how you'd phrase that?
Absolutely. Right after you define the floor at $27 to $27.50, you'd immediately follow with something like, the bullish consolidation thesis is intact as long as QBTS holds above $27. However, the invalidation criteria is clear. A daily close below $26 would serve as the immediate hard stop loss and nullify the near-term accumulation thesis.
Okay, yeah.
See? You put the risk boundary right next to the entry zone. The risk-reward ratio becomes instantly clear. For this kind of analysis, that clarity is everything.